The assignments and all that are that we do in class together, those are worth 20% of your grade. And the exams are 80%. The exams, importantly, are only email. They are not available in Blackboard. Now, the let's see here. Do one thing. All materials should be available to you, and other than the exams, will be available in Blackboard. So they're available in Blackboard, and this is where you can also, once you complete them, this is where you can submit them. So you click on this, and then you can submit you submit it in there. So anyway, so those will be available online. The only thing that's not available online are the oops, not that. The exams, and those will be emailed. Late work is accepted. So even though there's a date put on it, the exam themselves will be allowed to. You can turn them in at any time, but and the exams will be emailed, and anything can be turned in all the way up to the end of the semester, which for us, I think is March 16th. I'll have to check on that date. But anyway, so up until the last day, you can turn it in. Now, if you don't turn it in on time, you will you won't have a grade, obviously, so your grade's going to look bad. But for instance, this one, as of next Friday, I usually have them do on Fridays. So as of the end of Friday next week, this will become part of your grade. And if you didn't turn it in, you can still do it, but until you do, it's going to look bad because you're going to have a 0 in there. So anyway, as far as the course is concerned, we should finish up the equity method. This is going to be the first the first chapter we cover, obviously. And this is a method that we're going to use. It's actually used throughout, but it's a standalone one, which we'll see a few minutes here. But that's will be the first thing that we turn in. It'll be that chapter 1. So let's see here. And this is pretty much going to be the whole course. Chapter 4, we may or may not get through that. That one, it takes quite a bit of time. So we'll see if we get through, and we might not get through all of it if we do go through some of it. All right, let's jump into the handout. Any questions on that? Question on the course?
Yeah, I have a question. So this handout or this assignment, are we going to turn it in next week Friday?
Yeah, now because you're in the classroom, you don't need to submit it online. I'll just check it in. Okay. All the stuff we do in class, I'll just check it in. Okay. Yeah. Yeah, if you're in the classroom, I can check it in. But if you're not, if you're in Zoom land, then go ahead and submit it in Blackboard. And by the way, also, I can take it. We can take it in any form. So let me go back to this. I'll show you how this is set up. So it makes. So this is setting up the assignment. And when it comes down here to submitting, you'll notice that I have set up for unlimited attempts. And the good thing is, and here's why that is. It's set up for unlimited attempts because you can put as many documents in there as you want. And even if you submit something that's incorrect, you can just resubmit the correct document. So let's say you submit something that you didn't want to submit. You can just leave it. And when I go to it, if I see, it's attempt 1 out of 3, 2 out of 3, 3 out of 3, I'll just go to 3 out of 3. I'm thinking that's probably the one you wanted. be in there. So you don't have to contact me and tell me to take an assignment out or to do or anything like that. You can just simply resubmit the one you want to put in there. Also, it's unlimited number, so you can submit it any way you want. You can fill in the handout like I'm going to be doing in the computer. You can also do it by hand, writing it, if you want to print it out and then fill in the handout by hand. You can also just do it in notebook paper and then take pictures of it. So I'll take it any way you do it. The only things that are, I should put this in though. The only things that cannot be read by Blackboard, I thought I had that in there. I guess I don't. No, I don't. So anyway, you want to turn it in. The only types of files that cannot be read by Blackboard are as follows. Oops. Blackboard cannot process zip or page files. Zip files are Windows and page files are Mac. They're when you take a number of pictures and then combine them into one file. It can't do it. So this is the Windows version. They're exactly the same actually. And actually you can read, I can read Mac files and vice versa if you just change the extension on them. So there we go. Nope, that's Apple E. There we go. So so any file other than that, if you want to scan it in PDF or something like that, that's fine. It'll work fine. The only ones it can't do are the zip files and the page files. For whatever reason, Blackboard doesn't know what to do with those. And what will happen if you do submit them that way is that it'll look like it's pending on my end. In other words, it looks like somebody's working on a document and I can't stop it. So it's not my bad attitude. It's the bad attitude of Blackboard that it cannot take those files. So any type of file other than those is usually fine with. So if you just don't zip them and don't put them into page files, but you do it separately. And again, it's unlimited number, so you can put in 10 pictures separately, and it'll be fine. Any questions on that? I'll have that in Blackboard also, kind of a little note on that. But okay, so let's go to the handout. Investments. So we're going to start out with the investments, investment categories. And we're not going to do all of these, but we're going to do the ones that relate to this class. And they come in different flavors. The debt securities kind of have they have their own group now of different types that they can have. We actually used to have these types for the other groups too. The trading and available for sale, these used to be the fair value method. But those are separate now. So held to maturity and the trading and available for sale, and we'll talk about those in a second. Well, we might as well talk about them now. Debt securities. Held to maturity means that you held them to the entire amount. So these are when you buy something like a bond that has a 10-year maturity. If you're going to hold it to 10 years, there's a type of accounting that we do a held to maturity for the whole thing. Trading with securities are ones that can be sold at any time, and available for sale are for longer term. And we do not make those distinctions for equity securities. So if you're buying stock, we don't make those kind of distinctions. We use a fair value method, whether you're going to hold these stocks for 2 days or 25 years. We don't make a determination of length of time, whereas they do for the debt securities. Okay, and equity method is what we're going to be doing today. And consolidation is what we're going to start doing on chapter 2 and 3. Okay. So debt securities. And I'm going through these kind of briefly, but I just want to give you guys a little bit of a background on them. Just, you know, I imagine you guys are planning on taking the CPA exam, and they usually have something on there about these. So there's held to maturity accounting that is just basically, it's sort of like you just get you amortize the interest so that whatever you're getting, you know, matches up. It's basically the same as selling a bond, but you're on the other side of it. So you have to amortize the interest expense, yeah, especially in interest revenue on these. Trading securities, short term, they have gains and losses. These show up on the income statement. So trading securities, the gains and losses, these will be on the income statement. And you might be thinking, well, aren't all the gains and losses on the income statement? Actually, no. Unrealized gains and losses will be on the balance sheet in the equity section. They bypass the income statement. And oops, that's not how you spell equity, is it? One too many U's. So unrealized gains and losses, those will be on the balance sheet, and those will be in the equity section. These are what they call comprehensive income. And it's kind of a pain, but yeah, so the gains and losses from the short term on these, for the holding gains and losses, those will be in the income statement. The balance sheet will have the holding gains and losses will be on the balance sheet and the comprehensive income items, which is kind of a little bit unusual given these types of securities, but because they usually don't fluctuate that much in value, but for whatever reason, that's how they do it. We used to do this for stocks. We don't do this anymore for stocks. Okay, equity securities. These have kind of grown into some categories that they kind of give rules of thumb to. Okay, so fair value. By the way, both trading and available for sale are fair value methods. These are for non-influential holdings. Now, there are some rules of thumb for this that are not set in stone, but non-influential means that they can't influence the business. When they rolled this out, they gave some examples, and those examples showed that things that were under 20% were non-influential, and things that were over were. So this sticks in accounting people's minds that 0 to 20% is the rule. It is not the rule. The actual rule is whether it's influential or not. Now, if you don't know if it's influential or not, so you don't know if it's influential, then you go to the second best, which are these kind of secondary rules. And remember that accounting is generally accepted, accounting principles. And this was kind of generally accepted by people that anything under 20% was not influential and anything over was, which is it really depends on the business. Believe me, if you own 5% of IBM, you're very influential, and you probably got people on the board of directors. So it really depends on the size of the business and some other factors that go into it, and whether you're influential or not. Okay, so influential means that you have some sway in the company And certainly if you have people on the board of directors and that sort of thing, you will be influential. If they don't tell you, again, whether it's influential, then we fall back onto our second best, our option B of 20 to 50%. That means you are influential. It's like the windows are open, doesn't it? Why do we even have those? All right. You're getting to hear some of the excitement going on down here. See, that's an extra bonus. All right. Consolidations are when you get when one business has more than 50% control of the other one. And that is basically controlling it's over 50%. Now, they have given guidance that it could be below 50% and still be controlling. For instance, if you have companies that are closely related and they both own, 30% of a business, they might be controlling in that they really work together. So even though it could be less than 50%, it could still be controlling. So the best one is it controlling or not? And if you don't get that, then you go to B, which is anything over 50% is controlling. And that one is actually a good one. That one makes sense. These other two are kind of arbitrary. They just came from examples that were given when they rolled out these fair value guidelines, I don't know, 20, 30 years ago. Okay, so let's go through some of the multiple choice here. Purchased 5-year treasury bonds as an investment. Management intends to hold this investment for the entire 5 years. Which method are we going to use?
Held to maturity.
Yep, held to maturity. Purchase 5-year bonds investment. Management intends to hold this investment for 2 years.
Trading.
These are actually going to be available for sale, which.
But would it be available for sale after 2 years?
Yeah, it is kind of funny though. The wording on these is when you see available for sale, you think, okay, they can sell them at any time. That's actually not what they're. That's actually not what we. That's just, and that isn't. Available for sale are just considered longer term. I'm not sure why they use that name, but okay. Purchase 5-year treasury bonds as investment. Management intends to hold sell this investment within the next month. Yep, that's gonna be trading. And again, these are kind of vague terms, but that's what they're used. So we got to get used to them. Okay. Equity securities. Purchased 1,000 shares of General Motors stock as an investment. Management intends to hold this investment forever. Well,
Fair value method.
Probably, yeah, it's gonna be the fair value method. It's not 1,000 shares is not going to be anywhere near 20%. They don't tell you whether it is
How are you going
influential.
to know the basis for which you are measuring it against? Because someone can start your company and sell everything at 1,000 shares, and that's like the entire ownership of it.
Exactly. And if we didn't know what company this was, we wouldn't have any information on it. But the fact that it's General Motors and they literally have millions of shares outstanding. So yeah, if it's a small company, theoretically you could have one share be the entire company. So yeah, it really depends on the company is the number of shares, and the number of shares is only relevant as far as the percentage. Okay, purchase 1,000 shares. So again, these are going to be non-influential, and you're going to hold the investment for 3 years. Fair value.
It'd still be fair value.
So fair value.
Yep, exactly. All of them are going to be fair value.
Yeah, because it's based on.
They're not
the-
influential. We used to make the same distinguishing, for these that we did for the debt securities. We don't do that anymore. And I'm not sure why they didn't include the debt securities in that. I'm sure there's a reason, but I don't know what it is. I'll tell you another weird thing about these investments is all these investment rules were really intended for banks, but it took years for this to come out. And by the time they came out, one of the groups that was exempt from these rules are banks. So it was a bank problem that somehow morphed into our accounting rules for everybody except banks. Okay. More equity ones. Purchased 25% of LiveGo stock as an investment. Management intends to hold this investment for at least 3 years. Now, they don't actually come out and say whether they're influential or not. Yep. Yeah, given the absence, we go by the over 20% rule. Purchased 25% of 5Go stock as an investment. Management intends to hold this investment for the last 3 years. The other 75% of the stock is held by the founder of LiveGo.
That looks influential.
Probably fair value.
Why?
They're not influential. Someone else, one group owns the other 75%. So whatever they say, it doesn't matter. Whoever owns 75% are the ones that are going to make the rules.
However, doesn't the percentage fall within the?
Well, the question is, can they influence the company? And this actually tells that they can't influence it because they don't own. There's one block that owns all of the other stock. In other words, they can whatever the founder says is going to go. It doesn't mean that the founder isn't listening to anyone, but whatever the founder said, they cannot make the influence the company other than what the other 75% is. Now, again, if that 75% was spread out among other people, other groups, they very well could be influential. So it really, again, there's a lot of things that go into it. Whether they can be influential or not. But in this one, they're just going to be along for the ride because whatever the 75% of the founder says is going to go. Purchase 60% of the outstanding shares of General Industries common stock as an investment. Management intends to hold this investment for 2 years. Yep, it's going to be consolidation. They're going to have to take their financial statements and smash them together with the investment. Now, here's a kind of weird thing about this. Just to kind of, usually they use the equity method to do the accounting for it, and we'll talk about that later. But the equity method is usually used along with the consolidations. So the equity method can be used by itself, which is just putting it on the books, or it can be used in a complete consolidation, and they go together. So if you're influential, you use the equity method. If you are controlling, use a consolidation, and usually you also use the equity method with it, but you use it to on both the companies to put them together. Purchase 10% of the outstanding shares of General Motors stock as an investment. Okay, you're talking about billions here. Management intends to hold this investment for 2 years. Management has 2 officials on the board of directors of General Motors.
It is influential. That's equity method.
Probably the equity method. They're definitely influential. They have people on the board of directors.
Mhm.
Oh, 11, yeah, I threw 11 in there. 11 is about Ford Motor Company. I don't know if you know about Ford Motor Company. Ford Motor Company, the Ford family, they sell stock to the public, but then the Ford family has their own shares of stock, which really control it. So they have a lot more voting rights. So purchased 3% outstanding shares of Ford Motor Company stock, but only acquired 4% of the voting rights. It tends to hold this for 7 years.
Fair value.
Yeah, it'd probably be at fair value.
Fair value.
Okay, purchase 30% of the outstanding shares of Peabody stock as a short-term investment. Management intends to sell this investment when the stock price reaches $80 per share.
Fair value.
Yeah, they don't really tell us much about it. And probably the equity method, because they really don't say whether they're influential or not. You would assume that they are because of the percentage, but they really don't give you much information other than that. And part of our reason for going through these is kind of getting a feel for it, like what like on the CPA exam, you know, I used to teach the CPA reviews. We use the Wiley CPA review, and yeah, just kind of going through the, you know, one of the reasons that they put stuff in there like this is they'll have this as part of a problem, and you'll need to know how to do the accounting for it. You'll need to know what method you're using, you know, because these are going to be different methods. Okay, equity method is kind of a strange one. And you have to kind of think differently when you're using this method as compared to regular investments. And it kind of goes like, you know, part of it is, hey, I'm on the screen again. How about that? Part of it is that if you, for example, if you own 100% of a company and you take $1,000 out, are you any richer? No, you own the company. You take $1,000 out. Theoretically, the company's worth, well, not even theoretically, actually, the company's worth $1,000 less, right? So your investment in the company went down by $1,000. Now you have $1,000 cash, so actually nothing happened. And that's what we have to remember when we're looking at these investments. So if you own enough of a company, when you get say a check for dividends, you don't say yippee free money. You say, okay, I got this check for the dividends, but because I own it, I own enough of it. Basically, you know, I got the extra money. However, my investment's now worth less because of how much money I got. So if I get $1,000, I got $1,000 cash, but my company is $1,000 less wealthy, shall we say? So getting things like dividends don't really mean anything. It's just trading one asset for another. You know, yeah, you got the cash, but now your company's worth less. And the only way you make money is when the company makes money. So if the company has net income, then you know you make money. If the company has a net loss, you lose money. And it goes back to just being almost like a regular how you regularly run a business, rather than, oh, this is an investment, and when I get dividends, I say, oh, good, dividend revenue, because it's, you know, free money coming in. So it's different than oh, come on, I'm gonna do this every time. Every time I do it, they say, okay. Man, they got these locked down. All right. So, oh, I'm in the wrong handout
Should we
here.
expect the same class next time, or we're gonna change the class?
I'm sorry?
Should we expect the same class?
I'm going to see if I can get us just into a regular room. We have actually a conference room that can hold, 7, 8 people, which I think most people are going to be on Zoom. The way I've run this in the past, I've usually had 3 or 4 people show up in class, which would be fine for the conference room. I think there's, like I say, I think we can have up to 8 people in there. So that, and if we had more, we could even put more chairs in. But yeah, and the computers are a little easier to use. Okay, so the investment income. We have net income or net loss. So if the company makes money, we make money. If the company loses money, we lose money. It's possible that we will have excess things that are that we have to depreciate. For instance, they may have undervalued assets. When we change the value of those, we have to take into account that, okay, their depreciation is based on a different basis than ours is. So we'll talk about that later on. Comprehensive income, we're not going to do a lot with that, but it is there in case it comes up. And actually, this would be where the available for sale for the debt securities. You could have a comprehensive income for that, but we're not going to worry about that. All right. Gains and losses on investments are just regular old income. So if we have, if we do sell an investment and we get more money than we paid for it, it's a gain. Less money for it, it's a loss. And that just goes in a regular income statement. The account itself, it goes up when we have net income. So if our company does well, it's worth more. If our company loses money, it's worth less. I talked about the amortization of excess. We'll talk about that later. And comprehensive income items. But notice dividends received are subtracted out. We're no better or worse if we get dividends. Yeah, we get the $1,000, but we also, our company's worth $1,000 less now. So when we get dividends, it's from something we already own. Theoretically, we already own that money. So when it actually comes to us, it's not, it doesn't do anything. Okay. We're not going to do too much of this. It does get separated out into a different section, the gains and losses. Dividend income is not used in the equity method. We do not use the equity income, dividend income for the equity method. Dividends are simply them returning money to us that we already have. Okay. Equity method investments are long-term, so they're not current. And if they are to be sold, they are usually reclassified as current before they are sold. You know what? This is wrong. Scratch this out. Only the debt securities will be reclassified. If they are to be sold, if the equity investments are to be sold, they will be reclassified as current, but they will not be reclassified as available for sale. That designation is only for debt securities. I'm surprised I still have that in there. That's obviously wrong. Okay. All right. Let's do some problems here. January 1st. Prepare all the journal entries. Okay, so Franco Corporation was purchased for 30,000. No, 30% was purchased for 35,000. Doesn't say. I'm going to assume we paid cash for it. So cash, it's an asset going down for 35,000. Go down with the credit. And on the other side, we're going to have an investment. And we're probably going to put in that this is going to be the equity method. Or just equity is fine too. Okay. Now, Franco Corporation paid total dividends of 5,000 on May 1st. No, May 23rd. Okay, so total of 5,000 dividends. We don't get all of those. We get 30% of them. So the total dividends paid was 5,000, so we get 30% of that. What is it, 15,000? You may want to. Not 15,000, 1,500. I'm sorry. Okay.
So I have a question with the first entry.
Mm-hmm.
In this case, are we the ones doing the purchasing of the?
Yep.
Okay, so that's why our cash is going out.
Exactly. Yep.
And our capital is from.
Yeah, and then this is another one. Theoretically, this is. I'm going to take this off here. We're no better or worse off after this transaction, because this is an asset going up,
Okay.
and this is an asset going down. So, if it was done at an arm's length fair value, then we're no better or worse off trading one asset for another.
It would just affect your liquidity.
Okay. Previously, I thought of it as capital, the accounting equation, capital when it's increasing.
Yeah.
But once you put the asset, that kind of.
Yeah, it's and it is a different way of thinking about it. And actually, we'll actually see that coming down to this next one here. So cash going in, our cash goes down, our investment goes up. Down here, we're getting cash out. So we're getting a check for 1,500. Our share of the 5,000 was 1,500. So coming down here, we're going to have cash. It's an asset going up. Oops. And normally you would say, oh, okay, well, that's going to have, some kind of a revenue. These. That's 100. Okay, so 1,500. And you'd say, okay, well, on this other side, we're going to have some kind of revenue or something like that. Actually, no, we're going to take it out of our investment. Our investment is now worth less. Asset going down by 1,500. So we're not, we're not happy or sad about this. It's just that we're trading one asset for another. So we got $1,500 back. Our investment is now worth $1,500 less. They paid out this to us, and so our part of the investment is worth $1,500 less. And again, it is kind of a strange way to think about it, but they own so much of the company that at some point it becomes you know, just you're just taking it out of the piggy bank, basically. Your piggy bank is worth less now.
It's as if we are treating it as a drawing from your business because
Exactly. Yep. Just like being just like a drawing account. Yep. Okay, now this is where we make money. If you're wondering, we make money when we have net income. So they had net income of 20,000. We're not going to get all 20,000 of that because we don't own 20,000 of it, but we're going to get 30% of it. Oops. 6,000.
Yeah.
And so this, you know, actually our business is actually worth more now. Our investment is worth more now. So, let's see here, this was December 31st. I'll bold this whole thing. All right, so we're going to have investment income. It's possible they use different wording. They might say, you know, equity in income or something like that, or you know, from equity investments or something, whatever it is. But just investment income is fine. 6,000. And now the investment count will go up by 6,000. Our share of this income is 6,000. So our investment is worth 6,000 more. We get our share of that income. What is the ending balance in the investment account? Okay. So on 1/1, we had the initial investment. Oops. $35,000. Received dividends. $523 of 1,500. That reduced our investment. And then we had income on 12/31 of 6,000. So all these together whatever that is.
39,305.
Yeah, 30. We say 39,500.
Yeah, 39,500.
Thank you. So this would be our investment at the end. And again, it is a little bit strange. A couple of things. First of all, the dividends are negative. They come out of the investment because we have cash and it's just trading one asset for another. You'll also notice, though, there is nothing in here about the fair value of this stock. There's nothing about did the stock price go up or down. It doesn't matter. It doesn't matter if the stock price goes up or down. for this method, it completely ignores it. So if the stock is doubled in value, it doesn't matter. If it's, half as much as it was, it doesn't matter. We put it on the books based on what kind of money they bring in and what kind of dividends they pay out is, for the most part, how we determine the value of it. Any question on that? So market value is not relevant. I should change that. I'm sorry. Let's say fair value. It's not used anywhere in this type of problem. So, normally you think of stock, people talk about buying stock and hoping the value goes up. On this method, it doesn't make any difference. Okay. I think I'll be quiet for a moment and see if you guys want to give this one a shot. I'll fill it in here in a minute. So, number 6, you can use the same dates. Oops. Oh, I just something wrong there. Okay, let's see, 12,000, we get, what's that, 40%? Oh, I'm putting my answer before the question here. Crazy numbers in here. $74,800.
Yeah, 74,800.
Yeah. I got all different size numbers here. I don't know what. Yeah, again, this is, they paid out more dividends than they got in income for whatever reason. So that's why our investment went down. Okay, tell you what, let's take a break. Let's come back at let's say 7:14.
Okay.
Let's say be back at 7:14. I say 15. Let's go 15. And we'll continue on with this. I'm not sure if we'll finish this whole thing. Okay. So usually I'd have my microphone and all that would be on this page, but it's not. Oh well. Yeah. that you worked on?
Yeah, on the graphic side.
Oh, okay.
That's good. And actually, it's, like, I came in person today for this, come to class.
Oh, yeah, yeah. Yeah, it's so cold. I don't blame people for not coming in. It's, it's.
So tired.
We have such fluctuations now in our weather. It's crazy.
I was even wondering if you're gonna come, because
Huh?
I was wondering if you're gonna make it to class, 'cause-
Oh, yeah. Yeah, actually, I teach all day down here.
Oh,
Yeah. But, it's, well, like, like I said, it's just about getting all people coming. It's crazy. I had a kid, and we go to school that was like 13 below zero, and they didn't call him school. And I said, well, he's not, because, he wasn't far from school, but, walking, why, the weather service telling you, don't go out, unless, unless you absolutely have to. Okay. This is kind of give you an idea of what we're going to do next, and that is that a lot of times the carry value and the actual value for something can be different. It's very common in things like real estate. You get somebody who have real estate on their books for $50,000 that they bought, in the 1970s or something, and it's worth $15 million today, but they're carrying it for $50,000, what they paid for it. So oftentimes you'll see this kind of discrepancy that, and when you buy into a company, the people who run it are not stupid. They know that this stuff is worth more. But this is going to kind of give you just an example of what we have to do as far as adjustments are concerned. Okay, so Tom buys an oven from Sarah for $700 cash. The oven had a carry value on Sarah's books of $460. Okay, so Tom buys this for $700. So make the journal entry on Tom's books. Okay, well, Tom purchased it for $700. So probably equipment. You'd also put it as oven. Oops. So there's an asset going up for $700. And Tom paid $700. So we're going to have cash, excuse me, asset going down for $700. So, theoretically, right after this purchase, Tom is no better or worse off. He's out $700 cash, but he's got an oven that's worth $700. Okay, prepare the entry for the depreciation of the oven on December 31st, 2025. Assume that the oven has an estimated useful life of 10 years and no residual value. Okay, so this oven's going to last for 10 years, and then it's just going to be set out in the alley and scrapped. Okay, so the depreciation journal entry is a kind of a morbid way to remember it. It's DEAD. At the end of its life, it's dead. DE is depreciation expense. Oops. And AD is accumulated depreciation. Okay, so got a 10-year life. So $700 divided by 10. Oops, where am I? So this is going to be Tom's depreciation on this oven. Okay, so now, if Sarah had kept the oven, what would her depreciation expense have been? Assuming the oven had an estimated useful life of 10 years and no residual value. Well, she had it on her books for, forgot, $460. So this would be $46 per year. Let's probably put dollar signs in front of those. What would the incremental impact of Tom's depreciation expense versus Sarah's be on Tom's restaurant income? Okay, well, Tom's restaurant is going to get more depreciation than Sarah's. I am so sorry about that. Let me turn this on. Okay. Let's see here. So let's see. Tom has $70 a year. And notice for the same oven that Sarah has depreciation of 46. So the incremental impact would be, yep. So Tom is going to have $24 more depreciation than Sarah would. And again, this is for the same oven. And so this is what we're looking at when we talk about this incremental, that whoever buys into it, when they have to pay extra for these assets, that they're going to have a higher expense for them. Whatever percentage of these assets they buy, they'll have a higher percentage of it. Okay, so let's see how this translates down here. Excuse me. All right, the Signals Corporation bought 25% interest in Calhoun Corporation on January 1st for $55,000. Signals is able to exert significant influence. Okay, so they're influential. Calhoun had an income of $30,000 and paid dividends of $12,000. Okay. Well, let's take a look here at this. Now, we have carry values, but the business transactions really don't happen at the carry values. They happen at the fair values. So the fair values of these assets, if we add them up, what is it? So this is, oh, these are already added up to 370. Is that come out right? That doesn't look right. Yes, it is. This is right. Okay. So over here, we have to add these up. I think up to 410. Let me check that.
One. Plus 6, 10, 18, 21.
Yeah, so 410. So this is really where, let's just put it in. So the fair value of these assets are really worth $410,000. Now, we also have these liabilities. Now, the liabilities, oftentimes the liabilities are the same, and in this case, they are also too. Just because someone buys an investment doesn't mean that they take out more loans or anything like that. Okay, so let's look at the net assets, or what they might call the fair value of this thing. And the net assets are assets minus liabilities.
Are we doing it for both the carry value and the fair value? Or
I'm sorry?
are we calculating the net assets for both the carry value and the fair value?
Actually, we're only going to look at the fair values because that's what we're going to have to be buying. And again, like, so for instance, these buildings, just because whoever these people are, Calhoun, just because Calhoun has it on the books for 2,000, they're probably very well aware that it's worth more than that. And so when they, when we buy into them, it's going to be at the fair value. So net assets are going to be whatever that is. What is 410 minus 220? And by the way, if you notice something, so this is 220. They bought 25% of it. If you were to take this total value and multiply it by the 25%, you should come out with the 55,000 that they paid. You know, that's where this 55,000 came in. They bought a quarter of the company. It was worth, you know, at fair value, it's worth 220,000. And if they buy 25% of it, you'd expect that they pay 55,000. Okay, let's go through some of the easier parts of this. January 1st, they bought it. So coming down here, and again, this is kind of a journal entry sheet. By the way, when I took the CPA exam, they had this big sheet full of these, all these little lines. I never used it before in my life. It's like, what is this? Oh, this is counting something. Okay, so we're going to have our investment. And it's going to be equity investment. Oops. I forgot the E. The computer knows me. It's not giving me suggestions anymore. It's not going to help. Okay, so this is an investment going up for 55,000, and our cash is going down for 55,000. And again, theoretically, we're no better or worse off when this deal happens. In the future, we might be, but right now, we're not. Okay, let's take the easy ones. The easy ones, we can do the net income and the dividends. Usually the dividends come first. You don't know the net income until the end of the year. Usually dividends are paid during the at the beginning of the year. Scratch that. Dividends are paid during the year. The net income isn't calculated to the end. But it says looks like both of these were on 12/31, so it really doesn't matter which one we do first. Maybe I'll do the dividends first, just because we're used to seeing it that way. Let's do the dividends first. So December 31st. Okay, we get cash. It's 12,000, is it? 12,000. Equals what, 3,000? Okay, so we get $3,000 cash. And our investment goes down. By 3,000. There's an asset going up. We do the same thing with the net income of 30,000. Take our share of it. $30,000, 7,500. Okay, so in this case, our investment's going to go up. Oops. And our investment income will go up. However, there's one more thing we have to take into account. If you go up here, these buildings have an excess value of 40,000. Why do we keep doing it? These shortcut keys. Right, because these two, they have it on their books for 20,000, and when they do their financial statements, when they calculate their net income, this 30,000 net income, they're depreciating a $200,000 building. We have an investment in a $240,000 building. So the excess value is 40,000. Our share of that is 25%, or 10,000. So there is an excess value on that building of 10,000. Similar to up here, we're going to have to depreciate that extra 10,000. And they tell us it's for 5 years. So we got this 10,000 excess value. And it's including that 55,000 because it's excess value, and we have to spread that out over 5 years. So we're going to basically do an entry for the depreciation, the excess depreciation. Okay, so $10,000 is our excess divided by 5 years equals what, 2,000 a year. Okay. All right, so we're going to have to decrease our income by $2,000. We have a more expensive building than they do on their books. They got a $200,000 building. On our books, it's a $240,000 building, and we get 10%, or excuse me, 25% of it. Okay, so I'm in the wrong line. Hold on one second. Okay, we're basically going to reverse this entry up here by 2,000. We're going to reverse this out. So our investment income is going to go down by 2,000, and our investment's going to go down by 2,000. That makes sense?
Aren't we owning just the 25% of the building, even though it is 240,000?
Yes, yeah, and we're only taking 25% of it.
Okay, so 10,000. Okay.
Yeah, and if you think about it, it's sort of like this. It's almost like we're taking 25% of everything here.
Everything.
The only difference is that these are all on at book value, whereas this one is, the fair value is different. But yeah, if you were to put this on, break this up and put it on as 25% of everything, you come up with the same. Yep. So yeah, so this is, again, our share of it because we have basically a more expensive building on our books than Calhoun does. So we're going to reduce our investment. And so we'll do this for the next 5 years. After 5 years, we won't do it anymore. Why don't you show you something else that's kind of strange about the investment method? And that is this. Don't do that. You'll know something about the journal entries for it. It's a little bit different than what you'd normally think of. Every single journal entry has the investment account in it. So really, what you're really, when you do these entries, you're really just looking for whatever's on the other side of it. Because every single one of these journal entries has the investment account in it. So whenever you do something, of consequence in the equity method, it will have an impact on the equity account. And things like, the market price doesn't get reflected on your accounting records. It has no impact on, the value of it. So whatever the market price is doing for this, it doesn't matter. We don't take that into account for the equity method. Okay, do we have another one like that? Okay, about 30% interest in, hey, the same Calhoun Corporation. Lazy cut and paste job. All right, so these are all the same, aren't they? Oh, no, equipment. So this one's going to have the equipment account. It's going to be, it's possible you have a bunch of them, but the equipment account here, probably 370, I assume. $50 more. So the excess is 50,000. And we're getting 30% of it. So we're going to have to depreciate 15,000. I just want to see what it should come out. 57,000 sounds like a weird number. This is still 180. So our net assets at fair value. Oops. I don't think that comes out right. 370. $190 times 30. Oh, maybe it does. About 30% of it. It does come out to, okay. I don't know why that number looked funny to me. So that's how that 57,000 came about. Oops. And if you think about it, this, we're really buying 30% of everything here. We have 30% more liabilities, 30% more assets, and whatever those fair values are. Left a number off there. Okay. All right, so let's go just start making journal entries. There's a lot of space there. Okay, so January 1st. $57,000 asset, and we paid using cash. Paid out 57,000. At that point, we're really no better or worse off. Let's do the easy stuff first. Net income was 100,000. Dividends were 30,000. I'm going to do dividends first, just because they usually happen that way. Oops. And again, think about, the journal entries for this, they always have the investment account. So we got cash, the other side is going to be investment account. Same thing here, other side is investment account. It has to be in there. By the way, somebody will ask, do we have to put the asset going up or down? You don't have to do that. I'm just doing that to show why it's a debit or credit. Oops, that's not what I meant to do. Okay. And the income. Let's see, we have $100,000, 30,000. Investment account goes up. Investment income goes up 30,000. Okay, so those are the usual ones. Now we still have this though. Excuse me. And that is that we have this these equipment that they have on their books for 40,000, but when we made the investment, that equipment was worth more than that. It's worth 90,000. So our share of it's 15,000, and we're going to depreciate that over 3 years. Okay, so 15,000, 3 years. All right, so coming down here, we have was that 5,000? Ah, let's try that again. Okay, so we have to basically reverse out some of this income. 5,000 of it, to be exact. So investment income we're gonna go down by 5,000. And our good old investment account. We're going to depreciate that equipment, at least on our books, at 5,000. And after 3 years, we'll stop doing that. Make sense? I tell you what, we'll do this one. Maybe we'll call it a day after that. Let me take a look here. See what. We'll get these next two done. Is that it then? Is that it for the thing? Hey, okay, yeah, we will. We'll get to the last two done. There was something to turn in. Let me get, yeah. All right, so. They really don't give us much information here as far as, but they give us enough to do this. So journal entry. So first one, whatever they paid for, to put that in the books. Oops. Oh, I know why we do this one the way this one's tricky. This one is going to be tricky for the depreciation. I'll tell you why. So they paid 300,000. Now this is going to be 300,000 at fair value. Okay, so let's get the journal entry here. Investment, equity, asset going up. You do not need to put that in. 300,000. Okay, got the investment on the books. Income and dividends. Okay, I'm going to do dividends first again. Creature I have. It doesn't matter which one you put in first. Okay, Erickson had income of 100,000, so this is for the entire company, and paid dividends of 60,000. I know I put this one on now. Okay, so let's take the first one. Dividends were 60,000 times 25%, 15,000. So we got 15,000 of cash, but now our investment is worth $15,000 less. And again, that's because we own so much of it that is simply taking money out of the piggy bank or drawing account, as stated earlier. Oops, no, it's going down. There we go. Okay. income, 100,000. Investment equity. Okay, now this is where it gets tricky. It gets tricky because of how it's written. So they, Joan bought 25% of Ericsson for 30,000. No, they did 300,000. The book value of the stock purchase was 260. So they've already done the conversion for us there as far as percentage wise. This 300,000 is for 25%. The book value is separate. So the difference is 40,000, but that entire difference is in our investment. We don't take 25% of that difference. This is not the fair value. This is the fair value of the investment, and this is the book value of the investment. Just our investment of 25%. So this $40,000 difference is all going to be part of our investment. It's only
Sorry,
Hi.
I know the class going on. It's so quiet.
Yeah, we're accountants. We don't get allowed. We don't play any instruments or anything. You know? Maybe we should just bring some instruments in. All right. So the $40,000 difference, we're going to have $40,000 excess. And this is, all that is for us. And life of 10 years, okay. So coming down here, I don't want to do that. 40,000 excess. And again, I think I put this one in there, almost positive. I put this in there because of, I think there's a book problem that this was based off of. Okay, so we got to reverse out some of this income we have from the previous one. Investment income is going to go down. By 4,000. And our investment account. That's going to go down by 4,000. I think I'll give you guys this last one to do in the handout. This will be for homework, and then you can turn the whole thing in. If you have questions on it, you can ask next week. But, oh, here's the assets with the increase on row the debits and credits sheet. So anyway, yeah, so do this and then turn the whole thing in. And again, if you want to take, 10 pictures of it, that's fine. However you turn it in, it'll be fine. The only thing you can't use are zip files and page files. So that's the last thing to do. It's very similar to this one up here. Let me make sure that it's done the same manner. Yes, it is. Okay. All right. Any questions?